know it's no pain, no gain. Go hard till the end. What's the use of playing the game if you ain't aiming to win? My feet.
Thank you. Okay, thank you all for coming, sharing your night with me today. As I was telling some of you, this is the 5th talk that I'm doing in 2 weeks. Other than redoing this one from last week, I also gave a day-long version of that at the Stanford Continuing Studies. Are you guys familiar with this? You can take great classes there. So I did this whole Saturday from 10 a.m. to 5 p.m. Kind of a stretched out version of what you're going to see today, which is what we can do in an hour and a half on financial modeling, valuation, and funding strategies, which is, there's a lot of stuff to cover, but you know, we managed to do it last week for an hour and a half. We'll try and do it now. And if you ever want to expand your knowledge, you can always take that class or other classes that we offer. I do a lot of teaching. Also wanted to introduce Lynn, who's my director, and he came to help me out here. If you have any questions afterwards, you can also come to either Lynn or myself. So the other 2 talks that I gave were on intellectual property, which is my other area of expertise. So just a little bit about myself. I'll try and find the right distance for that. So if I'm shouting in my ears, let me know. Okay, if I can do without that, I would prefer. Let's see. Can you hear me?
No.
Okay. Okay, that's fine. So my background is a combination of consulting and entrepreneurship. I have a finance background. With that, I came into the area of intellectual property, doing work in support of lawsuits called damages work, and then I joined a consulting firm specializing in intellectual property strategy and management. So I look at IP. When I talk about IP, I talk about patents and intangible assets, technology or technology-based, which every company has. Looking at that as a business asset, so that's kind of our specialty. We have helped very large companies strategize around their IP, do transactions, and do valuation and strategy. But we also love working with startups. In my company, Foresight Valuation Group, where we're based in Palo Alto. I've been an entrepreneur myself. I've been there. I was a founder and a co-founder and a CFO and a variety of roles, and I kind of jump in and out of consulting and entrepreneurship, which I consider my startup to be my consulting firm to be a startup venture as well. So although we've passed the initial stage, but we also do, as a company, as myself, do a lot of teaching and speaking. That's kind of our not only business development but also passion. I'm a great believer in education. I'm an educator. I've educated my entire life. And currently I teach at Stanford. I teach a few things. I teach at the business school, an MBA class on IP strategy and valuation. I teach at continuing studies, like I mentioned. I also do a lot of other speaking. So I also live on campus, so Stanford is my home. My husband is a professor and my son is a Stanford student, so there we are. But I went to Berkeley, so I'm a Cal MBA, so. Okay, so that's about me. Now, what are we going to talk about today? So I'm going to check my phone for time, so I apologize in advance. Usually I have a watch on me, but I didn't have it today. So we're going to talk today about one of the most neglected areas of the pitch deck and of your startup planning, which is the numbers. And I see it all the time with people coming to us, and they said, you know, I just need this slide, like these 2 slides that say financials and then projections and valuation, and that's all we need. So what I think that what I'm going to try and explain today is that this is such an integral part of what you do as a startup that not knowing your numbers is that's just a non-starter. So you can't really go asking for somebody to give you money if you don't know how you're going to use this money, what are your cost items, how you grow your valuation. That's really important. Not just what your valuation is today, but how you grow your valuation. So a lot of what I'm going to talk about today is I'm going to talk about the trajectories. So the one thing about a startup is this is just the beginning of your journey, right? So when people come to say, how do you value a startup? I said, you know, that's an interesting question, but today is just part of the answer. So if you're starting a company, you kind of need to plot your way. You need to know what do you show investors in terms of return on their money. That's one side of that. But only you, but also you as the startup yourself need to know how the numbers work for your company. And I'm always very surprised that people don't really know that. I think it's easier than people think. So what I'm going to try and do the next 90 minutes or 85 is get you to think like I'm thinking about numbers. And you're not going to get all the answers today. Hopefully we get a chance to work with some of you, but even if we don't, at least I would like to come out of it thinking differently about numbers. That's my goal for today, okay? So we're going to talk about a startup, the funding cycle, which is really kind of the context that all the numbers live in. Then we're going to talk about startup valuations, which is one of my valuation is kind of my main area of expertise, so it's one of my favorite subjects. We value patents, we value technologies, we also value startups. So it's always interesting to understand how that works. And then we're going to talk about financial modeling, which is kind of the backbone for all of that. So if you don't have good financial modeling, you can do a valuation and you can go ask for money. That's kind of my opinion. So, but I'm starting from I'm starting from the end, going backwards. So I'm not starting from a financial model. I want to talk about funding, valuation, and then about financial modeling. And then we're going to show, if we have time, we're going to show a little example. I'm going to use a lot of examples as I go, so I'm a great believer in examples. So this is not just going over the bullet points. But at the end, we're going to have one example when we bring everything together. And that's kind of how our philosophy works when we work with startups on a funding strategy. This is how we work with them. So with that in mind, let's start talking about the funding cycle. My slides have gotten a shade of gray for some reason. That's okay. They don't look as colorful as they are, but believe me. Okay, so this is a company. I don't know if you can read the numbers. The important numbers to read are the valuation numbers. So this is a valuation. Yes?
Maybe you can dim the light.
Maybe I can dim the light. Maybe I can. No. Okay. I'm getting a no-nos. Okay. So this is a company, if you were paying attention to the news last week, this company had an exit. This is a real company. This is their starting valuation 2012 and their ending valuation last week. So who knows who this company is?
Dollar Shave Club.
Dollar Shave Club. Great. Okay. So I always look for valuation enigmas like that. And I'm a great student of the valuation progression of companies and trying to understand how and why, okay? But the reason I'm showing you Dollar Shave Club, is everybody familiar with this example? Okay, I'm just gonna give like a really brief background. I'm just using this to make a point, but this is a company that started with a viral video about subscribing online for razors, and I guess they ended up getting a lot of users. They had really good marketing, is what I'm understanding. And they ended up selling to Unilever, which is a large consumer good company, for $1 billion. Okay, so here's my question for you, okay? So wouldn't we all like to be this company, right? Who doesn't want to be this company? Okay, so let's say that you are going to talk to an investor, okay? And you're showing them this picture. You're standing here in 2012, and you are you, okay, wherever you are, and you're showing this is the company I'm going to build, okay? What kind of reaction do you think you're going to get? Dreaming. Dreaming? Okay. You think anybody's going to believe you? Does anybody think differently? Depends on who you are. Great. So point number one is who is telling the story. So a lot of our theme today is telling a story with numbers. So number one is who is telling the story. Okay, really, really important. So what you have to understand about the investment cycle and funding and all of that, it's all about people. Okay? So hence, Dia's website is probably one of the most important things that you can use. And it's all about warm introductions, and it's all about knowing the investors. So if it's somebody that an investor knows, or somebody that they know that has already made money for them, great. If this is Mark Zuckerberg pitching Facebook number 2, of course you believe the story, right? Okay, so number one is who's telling the story. Okay. Number two is, let's see, let me ask you another question. Now let's say that you are standing here, like somewhere here, okay? This is already known, and now you say I'm gonna get to $1 billion in 2 years. What do you think the reaction is gonna be now? Yeah? They might believe you better, right? So what has changed between telling the story here and telling the story here? Traction, okay. And traction is what does that give an investor? Credibility, confidence, okay. The general name for what I'm looking for is information. So at this point, there's no information, okay? Not about the company, not about the traction, not about the team, and not about the product, okay? Product and execution, two are the things that make a startup successful. So here, you already have traction, you have information, you have, it's easier to tell the story. So you kind of have to remember that as you're going throughout your funding journey, okay? There's going to be a point of increasing information. What you also have to remember is you control the information. You, the startup, you always have more information than your investors, always, okay? It's true for a startup, it's true for public companies. A lot of the companies we work with are public companies. We don't just work with startups. So as a public company, you have disclosure regulations. As a startups, you don't, okay? So you're not regulated by the SEC. You don't have to publish your financial statements. You control your information. You always know more than your investors. The only difference between you and a public company is how much regulation do you have to actually disclose this information, okay? So what you have to keep in mind is that you control the information, and your communication with your investors is about setting expectations. You can set them high, you can set them low. You can set yourself for failure, you can set yourself for success. So a lot of what we're going to talk about is how do you tell the story in a way that's setting yourself for success. So you don't just make up numbers, you don't So it's who tells the story and how much information there is. Okay, moving on. So what are the sources of funding that are available to you? So we're talking about the funding cycle, okay? We started with the story. Today we're going to talk about equity, okay? Equity, the definition, what I'm also finding a lot is companies, there's a lot of jargon and not everybody knows what it means, and that's okay. So if I say something you don't know, raise your hand. When I talk about equity, I'm talking about taking people's money in return for shares in your company. Okay, so they become owners like you are. Okay, they become co-owners with you. What the return to an equity investor is the increase in stock price, and as you become bigger and profitable, it could be dividends and other things. But equity, they're in for the long run. Okay, growing with you, and we're going to talk about different types of equity investors in a minute. What about debt? Is that something that's available to most startups? I'm talking about loans. Yes? Yes? Not in the early stage. So what do you need to be able to take a loan from a bank?
Convertible notes.
A convertible note, we're going to talk in a minute. But I'm talking about just straight debt, like taking a loan. Revenue, okay. So revenue, more than revenue, you need profit, okay? You need something to pay out, enough profit to pay out the loan, okay? So debt is usually not a very viable option. A convertible note is kind of a hybrid instrument. So it's something that starts looking like it's a loan with the intention of converting it into equity, with all due intention. Now, what is the one good thing about a convertible loan? Did anybody go through the convertible note, process? Yes?
Well, it's very easy to process. You can do it in a week or two. Very little paperwork.
Okay, little paperwork. And what else? No what?
You don't have to value your
No valuation, okay. So the interesting thing about convertible note is you delay the valuation decision or the valuation. It's not the priced round, what we call it. So you don't put a price on your share at that point. Unlike this, you're selling your share for a price. Here, you're taking a loan from someone to be converted into equity at some point, unknown point in the future, when you raise a major round. We're going to go over the cycle in a minute. For what is pretty much an unknown price, right? So the person is taking a risk with you, okay? What do you do to make the risk a little easier on the convertible note? Does anybody know? Discount. Oh, so you give them a discount when they convert their note to shares. And there's all things like dilution caps that I'm not going to get into, but there's a way to make it more appealing for them. Okay. Crowdfunding is a new, like I mentioned, a new and very exciting way to fund certain types of projects. I don't think it's for everything. It's good for certain things, and some of the, there's two types of crowdfunding. There's equity crowdfunding and there's rewards crowdfunding, which is the crowdfunding you do for products. Equity crowdfunding, I'm not going to talk about it. It's the Jobs Act. It's a new, just recently released regulations. You can actually syndicate crowdfunding online with non-accredited investors, and that's a new thing that's hitting the market now. But the rewards crowdfunding, like the Kickstarter and the Indiegogo, how many of you have done a crowdfunding campaign? Okay, how did that go?
Yes, successfully funded.
Did you meet your goal?
Yeah.
Okay, was that like a gadget that you had to deliver?
Yes.
Did you manage to deliver it?
Yeah.
Okay, good. Okay, great. So you're one of the exceptional ones. What's happening a lot of the times, yay.
I agree, my father, I'll show you later.
Okay, I would love to see that. So crowdfunding, there's a lot of upside to that, but there's a couple of downsides. One is there's a fulfillment requirement. So you actually have to, if you're selling like a gadget or some wearable, you actually have to deliver it. And a lot of these, I shouldn't say a lot, but a good amount of these don't get delivered on time. There's a lot of horror stories about that, and sometimes you have to refund your money, and it's not fun. The other problem is there's an intellectual property problem. So you're exposing your wares to the world in a very exposed way, and a lot of companies don't have proper intellectual property protection, and even if they do, it's really easy to steal. The designs have been stolen. I have a story that I'm telling on somebody who was not exactly a client, but a startup that came for some advice for me, and she put some beauty product online on Indiegogo, and at the same time her product was online, and she had a patent, okay? Somebody copied the entire campaign with the name, with the picture, with the product, and put it on Kickstarter. Just entirely, and it's really hard to get anything out of these platforms. They have no liability. They're just a platform. So just keep that in mind if you're ever thinking about that. And that's all we're going to talk about crowdfunding today. So we're actually going to talk about equity today, okay? Equity funding, okay? We can talk about debt funding some other time. Not very relevant for your stage, as I understand. Most of you are early stage, right? I didn't ask that. Who is looking for, is anybody looking for Series A funding here? Or Series A, okay. Seed and A, okay, we're going to talk about the difference, okay. So let's look at the equity funding cycle, so that kind of leads us into that. So we're still talking about the equity funding, the funding cycle, okay? Just laying the foundation. By the way, I'm going to give you my slides. So you can take pictures, be my guest, but I'm going to, if you give me your card at the end, I'm going to give you my slides. Yes?
There's a question in the slide before, there were a fourth option?
Yeah, there was the option of grants that I was not going to talk. Grants is like you can get like from the National Science Foundation. It's usually for scientific research and things like that. I was not, I'm just, sorry, I forgot to mention it. I was going to mention it and say we're not going to talk about it today. But yeah, we're going to talk about equity. Okay, so this is a fairly old chart. It's been around for a while. It's kind of the best one that I could find. What it does is, some things have changed. For example, we don't use 1, 2, and 3. Now we use A, B, and C. Okay, we have the letters now. But this is kind of showing you the types of investors. Anybody knows what the 3 F's stand for? Oh, okay, everybody knows. Okay, friends, family, and fools. Okay. What's interesting is that actually most of the investment of companies in the early stage come from these types of people. Okay, very little comes from VCs at the early stage. So these are people investing their own money. Okay, this is the difference. These are people investing their own money. Okay, angels and the friends. It's called seed or angel rounds. Here we're getting into the area of institutional investors. Okay, these are funds. Okay, these are funds that are raising money from others and investing other people's money. So these are professional investors. So there's a big difference between asking money for these people and asking money for these people. Not just in your numbers, in your readiness for funding. You have to be ready. A lot of people go for Series A not ready. Okay, you have to be ready. We're not going to talk a lot about that. I just wanted to put it down there. And as we talk about numbers, we're going to mention a few things that are relevant for that. And then eventually you have some exit. You either sell yourself or you go public. Going public comes and goes. Last year we didn't have a lot of IPOs, so the stock market, there's a lot of things about going public. A lot of the companies, kind of some of the new successful startups that have gone public have not been very successful. There's a whole, like I mentioned before, I talked about regulation of information, and there's a different way that the market prices public securities than it does public securities. The investors are different, but you know, it's a viable option. And as well as selling yourself, as well as just continuing and growing. I mean, that's another way. Build to sell or build to operate, right? Very different intellectual property strategy, by the way. If anybody's ever interested, come talk to me after. We can talk about IP, is a whole different talk. But okay, what has changed recently are two things that are important to highlight here, other than the names. First of all, the type of investor that you see here, so more and more of these people are coming into the early stage. So you see private equity, even you see VCs, micro VCs, you see people getting more into the early stage that have not been there before. The other thing that has changed is the time to IPO has gone much, much longer, okay? Typical VC cycle used to be like, I don't know, 3 to 5 years. Now you have companies like Facebook or, you know, some of the other unicorns or companies that have grown to be $1 billion in value that are staying public much longer. There's a lot of reasons for that. I'm not going to get into all of that, but it's important to remember. Since we're talking about valuation today, you're going to see much higher valuations than you ever seen before for private companies. Part of the reason for that is that these companies stay private longer. They need to keep raising money. To raise money from one round to another, your valuation needs to go up. So you see valuations that you haven't seen before. You see amounts of funding that you've never seen before. You see Uber raising $1 billion, right? Raising. Not that it's valued $1 billion, it's raising $1 billion, okay? So these are new things.
What do you think of that?
We're going to get to that. We're going to have a whole section about valuation after we talk about funding. We're gonna get all of our opinions aired out so everybody can have a chance to speak. Okay. I wanted to introduce this framework. It's I would say a deceivingly simple framework, but this is really the only way to think about funding, okay? Funding is an interplay between the funds that you raise, your valuation, and how much equity you're giving up to your investors, also known as dilution. Okay, everybody heard about dilution? Okay. In the class that I taught on Saturday, we spent 2 hours on the dilution exercise, explaining how to calculate that. I'm not going to go into that in great detail, but we're going to show some examples. Every time you raise equity, you give up some of your share, okay? Everybody understands that? Okay. So what's the trick to staying ahead? What's the trick to staying ahead? You as a founder, why would you do that? You want to increase the valuation of what? The company. Okay, so if you get a smaller percentage of a bigger pie, the increase in the pie needs to be exactly larger than the decrease in your shareholding. So that's kind of the math. It's not always as simple to calculate, but that's kind of the idea. Okay, so how much you raise is usually a function of your financial model. That's why you need to have a really good financial model. You know, people coming to me and say, I'm asking, how much are you raising? In the early stage, you say, oh, between 1 million and 2 million. That's a huge difference. When your entire pre-money valuation range in that stage is usually somewhere in this range, okay? If you're raising 1 million, you're giving up 20% of the company. If you're raising 2 million, you're giving away a third of the company. It's a big difference, okay? So, so that's that. So now the pre-money valuation we're going to talk about a lot. So we're going to, the talk that we have today, this is kind of a framework for our talk. We're going to discuss the financial model, which kind of determines how much you need to raise. We're going to discuss coming up, startup valuations. So we're going to talk about how you think about it. Okay, how do you even begin to think about it? And the third one falls out of that. So 2 of the 3 need to be known for the third one to fall out. So if you're raising 1 million into a 4 million pre-money, everybody knows the difference between pre-money and post-money? Okay. Anybody does not know the difference? Okay. So pre-money valuation is the valuation at the point before you raise the money. Okay. So let's say it's 4 million and you raise 1 million. Post-money valuation is very simply your pre-money valuation plus whatever you raised. So the value of a company immediately increased by the cash that you bring in. Okay. Now, what is the share that you give investors is whatever they gave you divided by the post-money valuation. So that's 1/5. That's 20%. Anybody ever see Shark Tank? Okay, so they do these calculations all the time. We'll go back to Shark Tank again when we talk about unit economics. That's where I like to mention Shark Tank again. Okay, so we're going back to our favorite example, Dollar Shave Club. So what I wanted to show you here is, and this is really another important concept, is I don't know how much you can see the numbers, but the amount that you raise are a function of your valuation. You don't want to raise too much when your valuation does not support that, okay? First of all, you probably won't be able to, but even if you could, it's better to kind of break it down or kind of have a strategy as to, at the points where your valuation grows, that's when you want to raise the money that fits that valuation so that this stays in balance, so you don't go out of balance here, okay? We call these points inflection points, so these are the points from one point to another. There's trigger events that make your valuation grow. Every industry has its own trigger event. If you're in the biotech and in medical devices, it could be an FDA approval. I know a lot of you are not, but this is like the easiest example I can give. If you're in software, there could be certain thresholds of number of users, or any product releases, or a partnership that you struck with someone that increase your valuation. And at that point, you want to raise more money at a higher valuation. So you always think about this triangle, okay? So you can see our friends here, they raised more and more money as their valuation was going up. Another thing to remember, that I always like to show that, and I had another company that I showed, but I just switched it with this one because this one just came out last week, is that you need to raise a lot of money you need to raise a lot of money to have high valuation. There's no free lunches here, okay? So when I showed this example, when I showed the first slide without the funding numbers, somebody in the previous audience raised their hand and said, oh, these guys only spent $4,000 on a viral video and they got really lucky. And so I don't really believe in that. These guys actually raised a lot of money, if you look at that. You might have some luck in the market, but really going viral, and you can't really count on that, all right? And another thing to remember is funding is hard work, okay? I probably don't need to tell you that. So I'm not here to dissuade you from raising money. We help companies realize their dreams every day. So that's kind of what we do in our company. But I just want you to keep in mind that the probabilities, the odds are probably against you, okay? So these are quotes from real VCs. I'm sure that, did anybody, by the way, think that the funding, odds of funding are higher than these ranges? Okay, well, I summarized it for you in 1% or below. Each of them says something that
1% of what though?
of deals that they see. So if you see 100 deals, you fund 1. Okay? If 100 people come to you asking for money, you on average fund 1. That's the 1%.
Would the ratio be a little higher if you're expecting?
If anything, the ratio would be lower here in the Bay. If anything. Okay, yeah. Maybe the funding would be higher, but not the ratio. Yes?
So at what stage is that number based on?
These are early stage. So the whole talk today is about early stage, seed stage, leading to Series A. That's why I asked, is anybody raising Series A? This is more for like pre-Series A funding. Series A funding, you move into the territory of the more institutional investors. There too, the odds are, some of these are VCs, but this is more for like seed funding and angel funding and things like that. Yes?
But so if you know, 1% for any given company, as an a company might go to 10 different VCs, so that's 10, like, you know.
Okay, what does 1% tell you? Okay, okay.
It just says that VC might have rejected them. Another company may have given them money, right? So
yeah, another company, but you could be the 1% for that VC. Yeah, but it's still the odds are low. Okay. Okay. Another thing, interesting thing to when we talk about the funding cycle, which is still our topic here, is to look at the deals themselves. So this is a trend line showing the amount of money being invested. This is US, okay, and the number of deals. The number of deals is this line, and this is quarterly funding. There's a lot of places, CB Insights. There's a lot of places you can get this data. So when you look at the number, when you look at the volume of funding, what do you see? You see increase, right? What do you see when you look at the number of deals? Increase? Kind of flat, right? Okay, so what does that tell you about the average size of a deal?
Bigger.
Going higher, right? The average size of a deal is going higher because this is going up much faster than this is, okay? So that's the one thing to remember. Now, another thing that I wanted to show you is, I don't know if you can see any of these, but let me tell you, this whole thing is software. So here what you see is, you see the industries that are more likely to be funded. So these are like by distribution, the industries that get more of the VC, this is VC funding, so this is venture funding, okay? Now, some industries are glaringly absent from this picture. What kind of industries are you looking here and say, gee, I don't see that industry?
Restaurants and consulting.
Restaurants and consulting, okay. Why do you think that is? Or that would be services, maybe? If we, do we have that?
Because you don't have the same leverage. If you pick the right technical team for software, you have a lot of leverage.
Okay, so there's no technology, is what you're saying?
Yeah.
Okay, the upside is not as high.
Yeah.
Okay, that's a good point.
Multiple of them.
They need a high multiple, a high return on their investment. We're going to talk a lot about the return. Yes?
It was the same actually. Companies that doesn't have like the ability to scale.
The ability to scale, okay, to make the VC the return that they need, right? What about some areas with tons of technology like semiconductors? Do you see any semiconductors here?
Hardware is really expensive.
Hardware is expensive. What does that mean, that hardware is
Really
expensive? Okay, so what would that mean in this setting? You mean that
Well, there's a lot of investment up front. I mean, that if you look at the business model of being a VC, it's putting a fairly small amount of money in and banking on it to keep after next.
okay, so what you're saying is that the amount of money you need as a semiconductor company is outside the range of what a VC can invest?
For the ROI.
Okay, okay,
Yeah.
good point. Okay. Now, what other industries are we not seeing here?
Utilities.
What about clean tech? What do you guys remember the days when everybody invested in solar? And where is all that? Very little energy, and most of the energy you see today is not solar. It's things like wind and water. And,
Do you know what the breakdown is between enterprise software and consumer software for the software section?
Where's that?
Do you know what the difference is between enterprise software and consumer
Oh,
software?
here.
Any idea? I mean,
I would think that now it's more enterprise than consumer, for sure. If this is 2015, what exactly is the breakdown? I don't know. So what about clean tech? Why do you think we're not seeing a lot of investment in clean tech? So that's an energy that was really in favor, in vogue. I was a co-founder of an energy efficiency company in 2007-8. So other than the financial markets going down, we had there was a period of funding that kind of suddenly dried out.
Prices of energy went down.
Prices of energy went down. That's really important to that's a really good point. So you always have to look at it in the yeah, that kind of goes up and down. But what else happened in this company?
Government
Policy, government policy, and did you? How many public solar companies do you know?
Like 2 saturated already.
2. So one is Solar City, saturated. Okay. So what happened is there were actually no exits. So when there's no exits, no acquisitions, a lot of them didn't survive to a point of an exit, then that kind of trickles down back to the investment. So when you see no exit, you don't want to invest because there's no upside, okay? So this is just something to think about when you approach a VC. Some industries are just not a good fit for that business model for a variety of reasons, okay? Okay, so that was the funding cycle. Now we're going to talk about valuations, okay? Continue. Doing fine so far? Have any questions?
Questions at the end or now?
Huh?
At the end or now the questions?
Questions? You ask, we're talking all the time, right? Yes.
So my company is funded in convertible note.
Uh-huh.
One of my investors told me when you launch the MVP, raise the more money that you can. I have 14 people in, everybody working for equity. But I have another mentor that said, no, you have to go low at the seed, like 500,000. And I said, I don't know, because my investor already have like, I don't know how many million exited. He knows what he's talking about, but my mentor said, no, your company is so solid with your revenue, you can make it. But that money that I raised is already gone, like the money goes like...
Okay, we're going to talk about, this is all the questions that you're asking me fall under the umbrella of what I call funding strategy. We'll get to that.
Okay.
That what you described is exactly why we're doing that. So you can answer that question, okay, based on your numbers, okay, and understand the ramifications of doing this versus doing that, okay. You know, I'm not sure we'll get exactly to your specific situation, but at least we'll provide some tools to think about it. So you are not at the mercy of your advisors only. So you have some independent thinking too. Okay, so let's talk about valuation. So valuations have been very interesting over the last decade, all sorts of things. Did any of you take a business or finance class where you learned valuation principles? You're the MBA student, right? Okay, so I'm gonna let you explain this example. Okay, see what they teach you in business school. I know what they teach at Stanford, but you're at UC Irvine, so let's see what they teach you there. I can tell you they don't teach that at Stanford either. So what's in $1 billion? So these two companies sold on the same week in 2012 for the same $1 billion. Okay, two very different companies. Anybody recognize what this motorcycle is? Ducati. So this is Ducati Motorcycle, very, very famous Italian luxury motorcycle manufacturer. Sold to Audi for $1 billion. This company had 500 million euros in revenues and sales all over the world and 100 years of corporate history. On the other side, we have Instagram. Instagram, 16 people, 1 year in business. What did Instagram have though? Users. How many? Anybody remember? 13. Anywhere between 30 and 50 million, depending on what you read. Okay, can you explain these two valuations to us and how come they're the same?
Price is the same. We the projections, percentage of sales.
Projections?
Projections, they usually projections.
Okay, so you think Instagram? Just what kind of projections do you think Instagram had?
I mean, in the long run, it has to be increasing. The body growth rate also.
Okay, so what's driving the valuation of this company?
It could be relative valuation, but it's the image, the 100 years, like you mentioned.
Okay, what's driving the valuation? That's a simple answer. Revenues, financial ratios. Okay, what's driving the valuation of this company? User. Okay, something else. That's not financial ratios. So if you went to business school, that's what you learn. You learn corporate finance, theory of valuation. You learn that valuation. You learn all theories of valuation. They all come back to revenues and revenues and profits and multiples on revenues and profits. Okay, this is the new paradigm of valuation that we live in. Okay, so you see more and more of these companies where valuations are not for sure driven by revenues at all. Okay, maybe some future revenues, but what do you have today? Today, in this case, you have users. Okay, now we actually have a lot of these companies. There's the unicorn leaderboard from Crunchbase, which we follow very closely in our company. We're actually doing all sorts of studies on them. One of them looking at their patents. Anybody who's interested, I can send it to you later. But a lot of these companies, not all of them, there's a whole list. These are like the top ones. Many of these companies, to the extent that you know, because these are all private companies, otherwise there wouldn't be a unicorn, okay, don't have the revenue level or the profit level, if they even have a profit, that would justify the kind of valuation that we're seeing here. Okay, yes?
also given a Theranos issue that has now?
Everybody asking about Theranos. This is taken from Crunchbase as of last month. We didn't fix it. I don't know how much Theranos' actual valuation is now. Maybe they're out of the list. So, good point. Okay, had a few issues. Okay, so what is driving the valuation of companies, a lot of the unicorns, is what we call KPIs, which is key performance indicators, which is operating metrics, a lot of them related to users. So a lot of what we're going to talk about is software related. So a lot of these are software companies. So I'm not necessarily having a software theme here. So if you have any question about another industry, just ask me. We cover all of them. But a lot of where you see these unicorns and is in the software industry. The large definitions that Crunchbase uses are things like consumer internet, which is like the Ubers of the world, shared economy, complex marketplaces, things like that. But in their basis, they're software. Okay. So there's all sorts of user engagement metrics. It's not just users. It's how the users interact with the platform. It's how sticky they are, how many times they come. There's whole dashboards that companies keep of these metrics. And we're going to talk a lot, actually, when we talk about financial modeling, we're going to talk about the Sas business model. Are you guys familiar with the Sass acronym? Software as a service? Okay. So everything moves to the cloud delivery, an entire change in the economics of the software industry, going through a big shift right now. And a lot of that is driven by these kind of metrics. And companies need to follow these metrics very closely to show that they are viable, because they can't always show the profits and the revenues. So these are kind of a proxy for profits and revenues that are going to come sometime in the future if you manage to monetize. Not every company, a lot of companies have built massive user bases and are not doing so well in monetizing them. So there comes a point where a company like Twitter is the best example, if you're following the news, is a company that's struggling. Because they can't really find the way to monetize, and they have 300 million users, which they can't seem to grow either, which some people think is a problem. But other companies have been able to more successfully do that. So getting the users in the early stage is a proxy for valuation. Some point down the line, when you get to an exit point, you should have a monetization strategy. So I'm not advocating that revenues and profits don't matter. What I'm saying is that a lot of the valuations in the early stage, a company like that, are driven by users, okay? All right. When we talk about startup valuations, the one thing to remember is that you should put yourself in the investor's shoes, okay? So a lot of founders that we work with, or just that I meet or talk to, don't really get that. So you have to think like an investor. When you negotiate with someone, negotiation 101, you kind of have to understand what's driving your counterparty. It's the same thing here, okay? So when you think like an investor, what do you think? What are the things that drive an investor when they evaluate a startup from a valuation perspective, okay? They have investment objectives. We talked a little bit about that. So you hear things like 10x return, 5x return, whatever the return. So they want to see a certain return of their money. It's really important. They invest to get a return. There's no... it's very simple, actually. There's a certain exit horizon. So if you are a angel investor, versus a VC, you might have different horizons of how long you plan to stay with the company.
What do you think the average VC?
I think it's getting longer. I think exit cycles used to be 3 to 5 years. Now it's much longer than that. That creates a whole other set of problems. Not just for VCs, but also for founders. What do you think is the problem with staying private too long? What do you think is the problem?
Run out of money.
No, you can get funding. Liquidity. Okay, liquidity is a huge problem. So what do we see in the market that kind of addresses that? Right, so we see the secondary markets, which is a way for private shareholders to sell their shares. And that's a recently new phenomenon, and one of the reasons for that, or the main reasons for that, is the companies are staying private for a long time. Also for the VCs, some of them want to cash out too, Some of them have limits, so you can't sell right away. I mean, as an institutional investor, you can't just buy and sell. There's things you can do and things as this type of investor, but in general, that's part of the problem. The other thing to remember is there's all sorts of investor dynamics. So investors are people, okay? And they invest in people. So a lot of it is people driven. You can run numbers and look at code and look at a lot of scientific things, but at the end of the day, it's all about the people. That's why what Dia is doing is so important. Getting introduced to people, people to know you. It's like 90% of the investment decision in my mind is people. So there's fear of missing out, which is a well-documented psychological phenomenon of people just want. So what creates like another name for that is herding or hype, or like people are fueling each other with their. They want to be in on the deal, right? So that's one thing that's important. Another thing that's important to remember, there's more money coming into the early stages, there's more competition on each deal. You might not be feeling that, but on the investor side, that's something that's driving things. Other things that are important for investors are industry benchmarks. So when they look at a company, they want to see valuation comps for what you can have comps for, if it's users, for example. They want to look at exits, is what we talked about before. They look at your competitors. One mistake that I've seen in a lot of pitch decks, if I can digress a little bit, is that people don't have a competition slide. So they ask you, who are your competitors? We have no competitors. That's not a good answer. You guys know that already, right? Okay. Okay, good. And the last thing is company metrics. So they look both at the industry, but at the company specifically as well. So the team, number one. Who's on your team? If you have a good balance of skills for what you need. When I say product, what I talk about is looking for something that solves a problem. That's really important in the product being a good product. What are your execution skills? So whatever traction you have is a good proxy for your execution and scaling, which is really important for a VC because they want to see the big whoop at the end, right? And intellectual property, which is what we advocate for. We're going to talk about intellectual property a little bit later, but what intellectual property gives you, it gives you rights to your technology, and it gives you the ability to pivot from your current idea to another idea. It gives you a way to enter new markets, give you a lot of things outside the immediate iteration of the product that you're making. That's the greatness of intellectual property. So highly recommended for everyone to have an IP strategy. And so these are all of these things are things that investors look at IP as more of a barrier to entry. A lot of investors are very ignorant about IP. They don't really understand the whole set of benefits that good IP portfolio affords to a company. We have helped a lot of our clients communicate that to investors. We sometimes do a valuation of your IP if you have enough IP. That can support your funding a lot. So there's a lot of things you can do with IP. Okay, so we're going to talk about early stage valuation methods. I'm going to show you a couple of examples. Since a lot of these companies, like we said, or you're at the early stage, don't have revenues, you have projections of revenues. So you can do a discounted cash flow. Do you guys know what that is? Okay, discounted cash flow is just a way of taking all your profit projections and discounting them back to the net present value. Am I saying something that people know? Okay, so taking future cash flows and bringing them to the present with a financial formula. That you can do when you have a very good grasp of your financial model. But a lot of the companies we talk about, including you, probably most of you at this stage, or how investors look at that is another way of the financials are not quite there yet. So we're advocating to work on your financials, but in a lot of the early stage funding, these are some of the valuation approaches that investors apply that are common, okay? And that helps you kind of understand how investors think about valuation. So comparables, VC valuation approach, and what I call the heuristic approach. And by heuristic, I mean people bring into an investment a lot of their own biases. So you have to remember that. So there's not always a scientific calculation behind the valuation. Sometimes it's just, I'll show you an example of that in a minute. Comparables is the most common way to figure out what valuation should you be going with at the early stage. There's actually a fairly well-defined range. And it is a function of how much you're raising. So if you're raising $1 million-ish in that range, This is kind of the range of valuation you're looking at. Pre-money, okay? Pre-money valuations. This is from Angel List, so this is a documentation of their own companies. So you see a range of anywhere between 2 million and 6 million. This is another source that I like to go to. This is the Halo report from the Silicon Valley Bank. They issued these, I believe quarterly, but this is kind of comparing 2014 to 2015. So what you can see here is you can see that the median valuation, which is kind of in line with this, has gone up from 3 million to 4.6 million. Big increase, right? Okay, so when you see something like that, and you remember the triangle that I showed you at the beginning, what do you expect to see in addition to that? If you say that the median valuations have gone up, what else must have gone up?
Deal size.
The deal size, okay. Assuming that the percentage is about the same, right? So there's two things that could have, you either say, okay, people keep investing the same amount of money, but for less percentage. But what's more likely to expect is that the percentage is about the same, but the deal size has gone up, which it actually has gone up. So this is kind of consistent with that. So that's kind of what I want to show you, the triangle in motion, okay? So it actually works. So yeah, so everything has gone up. A lot of that is a result of the fact that valuations in general have gone up, and if you bring into consideration the return and all this formula, then funding rounds have gone up. People are investing more, the valuations are higher. Okay.
I'm sorry.
Yes?
What do you mean by deal?
Deal to me means an investment. Sorry, okay. Sorry for deal to me is a transaction or an investment. Okay, so I should use that. Sorry about that. Okay. So the other one we're going to talk about is the VC valuation approach. That's a very common way that investors look at things. I'm going to work the math with you. It's not very complicated. That's probably the highest level of math that we're going to do today. So let's say you want to invest $1 million in a company, okay? And you want 10x return, okay? So you as an investor, I'm talking about the point of view of the investor, you need to make $10 million to make your 10x. So far, understand? And let's say that's the exit horizon for you is 5 years. So in 5 years, you want your share to be 10 million. Okay. Now, number one, you know that because you know you know how much money they're asking you, and you know your horizon. So you can know this number. What's also known is that the company is presenting to you a financial model that's showing a revenue of $20 million in year 5. And this is why it's really important to stretch your projections below like the next 2 years. Investors need to see their exit point. They need to be able to make these kind of calculations. So if in 5 years you're going to make $20 million, and let's say you're a software company, and let's say there's a multiple of revenue, everybody's kind of familiar with that, that determines your valuation. And let's say that based on that, and I put 5, which is not unlikely for software, you will be a $100 million company in 5 years. Okay. So for this investor that wants $10 million of $100 million, they need to have a 10% share in year 5. Everybody understand that? Okay. That's given, that's calculated. Okay. Now, there's something called dilution, which means that you will be diluted over time. So whatever you start with today, you will be diluted over time. Your share is going to go down. We talked about it. That's true for founders. That's also true for investors. Investors have ways of keeping their share if they want to keep investing, but let's say this one doesn't, okay? So a 50% dilution, that's not unlikely. So in order for you to end up with 10%, you have to start with 20%, okay? So far? Okay. So if somebody's asking you, remember the triangle, so I'm playing with all different sides of the triangle now. If somebody's asking you to invest $1 million and you want to end up with 20% share, then the pre-money valuation for that deal for you needs to be $4 million. So that's, the valuation here is driven out of all of that calculation. Okay? Anybody have questions about this? Yes?
How do you arrive at the 50%?
Okay, that's a question I got, like, this is the third time I'm getting this question now because I've given this talk 2 times before the last week. This is something that you either know based on your experience from other investments, Okay, there's data sources in the market where you can kind of find ranges for that. And if you do your financial model right, then you as a company, you as a founder, this is an investor. So investor is kind of based on their experience. But you as a founder, if you want to know your dilution, we're going to show that when we talk about, if you do a financial model right, you can kind of estimate roughly. I mean, it's not going to be 100% accurate.
Is that like four events?
It could be 80% for a founder dilution. You can start with 60% and end up with 5%.
But this is like three rounds at 20%.
Roughly, yeah, maybe 2 rounds, 3 rounds, yeah.
What kind of multiples do you expect for other kinds of things?
Okay, that's a good question. And last time I got it, I didn't have an answer. I mean, I didn't have it often, but then where's the slide? Oh, I thought I had it here. I put a slide that I didn't have here, but I have a slide with other industries. Software is fairly high. You know, other industries are below that. But I have a slide. I'll add it to when I send you guys this one. I'll add the slide with the other industries.
Is this software integrated for the SaaS kind of model?
Okay, within the software industry, if you look at paid-up license, like on-premise as opposed to SaaS, SaaS is much higher. SaaS companies have the highest multiples. 7, 8, 6 to 8 as opposed to 4 to 6, maybe. I have a lot of studies on SaaS companies, so I can say that too. Okay, so that's that. Okay, so that's valuation number 2. Now, valuation number 3 is what I call heuristics, and what I mean by that is whatever investors bring into the process, which is their own biases. So everybody knows who Dave McClure is? Okay, at the risk of promoting a competing incubator, this is an incubator called 500 Startups. It's really famous in Silicon Valley. Dave McClure used to be part of the PayPal mafia, which is like the guys that started PayPal, and then each of them went out to roll their millions into billions. So he's one of them. So he started this incubator. So anyway, so he was speaking at an event, and they asked him, "How do you value a company?" And he said, "There's 5 points of valuation. Each of them is $1 million." So the reason I'm showing you that is just to show how arbitrary it is. But a lot of people actually think like that. So if you're an investor and a company can show you numbers, and you have that in the back of your head, and they show you a valuation that ends up in $10 million today, but you're saying, really, you know, in my mind, an early stage company is never going to exceed $5 million. And these guys don't have a good team, so they're $4 million for me. And you can show, it's just in somebody's head. So all I want you is to be aware of that. I don't want you to practice this because you can't. I just want you to be aware that this is how investors sometimes think about valuation. Okay, and so these are the points. Don't ask me what they are. I mean, you can, but I can give you my guess. These are not mine. What I added to that, I added intellectual property is another $1 million. I think it deserves its own $1 million. But a lot of that has to do with what is the market potential, what is the product. The team is really important. I would probably say that, you know, I would give more to the team than I would give to a lot of these others, but
especially in like really early stage.
Yes, I mean the question was early stage. I don't think it was very well defined.
This is what I see. Like some of the like serious investors, or like serious VCs, they keep seed as seed. Like they know it's investing in people, investing in schemes, investing in divisions. At the same time, sometimes it's free product and free market.
Right.
Some other investors, especially smaller ones,
right?
They think in kind of like around A mindset, talking about seed, like we want to,
you want to see traction,
we want to see product, we want to see everything.
Exactly.
But it's not really seed.
Exactly, but you know that at the end of the day, they write the check. So I mean, there's no like official definitions, but there's kind of conventions in the market. And what Series A, the size of the rounds and the valuation ranges are very different from the early stage. Okay, so we're on to our third topic, which is building a financial model. So we talked about the funding cycle. We talked about valuations. Now we can talk about building a financial model, because without understanding where everything plays, we'll just end up with numbers on the board, and that's not what I want you guys to do. So financial models for startups have a very bad reputation. Somebody that came to us to help them with a Sass model. She's actually happens to be a good friend of mine, and what she told me is that she came with really high numbers, and I said, how are you gonna get there? You know, because I always ask that. I always ask, how are you gonna sell? And the answer was, well, actually my actual numbers are much lower than that. But what my lawyer advised me is that I should take all my numbers and double them, because investors are going to cut them in half anyways. So I don't know if that's good advice or not. That's definitely symptomatic of a lot of what's happening, a lot of the mistrust in numbers that there's out there.
What happens if your numbers are actually high? Actually, some people advise you to cut them.
Okay, so let's talk about how to build numbers the right way, and then we can talk about how to communicate to investors, because it's if you believe in your numbers the way you believe in your product. So a lot of people are, you know, when it comes to your product and what they're like all like very, you know, as you should be doing, pitching very passionately. When it comes to the numbers, it's like, people kind of don't have the answers, don't know. Some of the problem is a result of the fact that a lot of the modeling is done from the top down, as opposed to from the bottoms up. So what do I mean by that? I mean by that is that a lot of people come and say, this is a $10 billion market, and if we only had 1%. Okay, how many of you said that before? Everybody said that. No. It's very common. It's common. It's a common way of if you don't know how to create the numbers, which is hard work. I mean, creating your numbers is hard work. Taking a number out of the market and saying if I only had 1% might sound like a plausible thing to do, and I think that a lot of that kind of modeling gives numbers a bad reputation. So I'm all ground up. That's all we're doing. Ground up, and then you benchmark to the market, as opposed to start from the market as your benchmark and then hope that somebody believes your numbers, which is not going to work. Okay? So, our approach, we call it CURVE. It stands for cost, users, revenues, and valuation. Users is the first thing. We always look at users, and when I say users, I mean users or a unit or whatever it is that's your unit of modeling. We need to understand the economics, the microeconomics. And that's where I'm always going back to Shark Tank. And if you ever watch a show, after they listen to the pitch, do they always ask the entrepreneurs? How much does it cost you to make it? And how much are you selling it for? This is just simple economics, okay? Revenue, cost. At the unit level. If you don't know your unit economics, you cannot put a financial model out. You cannot go ask for money, you just can't. Okay, this is where the buck stops, okay? So if you take one thing out of today's talk is this. Okay, so we're gonna talk about unit economics. Then we're gonna talk about costs and revenues. Okay, so we start with that. Then we model costs and we model revenues separately, okay? Another problem that I see in financial models is people coming with costs that are driven as a percentage of revenues. There is no such thing as a percentage of revenues in an early stage company. You can say, oh, in my industry, cost of goods sold is 50% of revenue and R&D is 15%. It doesn't work like that. You are going to have 150% of your revenue, if you even have revenue, as cost. Okay? There's no correlation between cost and revenue in the first few years. As you move along in your evolution as a company, then eventually you converge to industry ratios. But you can't build a model for your first 3 years. It's really important. Okay, so we're modeling costs from the ground based on the user economics and other things. And you're modeling revenues based on thinking about monetization, which I'm going to talk about. And then and only then can we talk about valuation and funding. That you have to go through these first, okay? So let's talk about what are your goals for financial modeling. So your goals for financial modeling are, First of all, to manage investor expectations. So we talked about that. These are a lot of things that we already talked about. Understanding your trajectory, not just the valuation today, but what is your trajectory, okay? Always remember the door shape club that I showed you. Set the foundation for funding strategy. We talked about that. So you know how much money to raise, and you know how much dilution that means for you, okay? And then you create an operating budget, which is really important too. So on the cost side, if you do your valuation right, then it serves as a budget for you, so you know what your burn rate is. What's the first question investors want to know is what's your burn rate, and you can prioritize your spending and you do a lot of other things. Okay. So 3 steps: users, revenues, and costs. Okay. Let's talk about user economics, or unit economics. Okay, so I call it rollout because based on that you model your growth, okay? So there's a few best practices and then I'm going to show an example. So when we talk about unit economics, the first thing is, or units growth, you need to identify your modeling unit. So whatever it is in your industry that you're modeling, it can be a user, it could be a unit of product, it could be a subscriber, it could be a channel to market, what I call an intermediary. It can be a lot of different things. Whatever it is that anchors your model. I can't tell you offhand for every industry, but you know there's good kind of common sense recommendations for most industries, and then sometimes we have unique cases where we model something else. Select your business model. That's really important too. So how are you gonna grow? And there's a lot of things in that. Are you selling?
Mixing some of these models.
You can mix the models. I'm a good advocate of simplicity. We're gonna talk about that in a minute. Keep it simple, okay? You can mix and match, but keep it simple so investors understand what you're talking about, and you understand what you need to do. It's not just for investors; it's also for you, okay? So you need to understand your economics so you can represent it. And when I talk about the economics, I talk about the incremental cost. So what is the cost of adding 1 unit, and what are you going to make off of that unit? As simple as that. And align your unit story with all the other stories. So what do I mean by that? What I mean by that is that the numbers in my mind are the last thing that you do. There's things that you know that you need to know and plot out your timelines for product, R&D, IP. If you have an IP strategy, that's really important. Some of these days it can be very critical. And launch, which is your marketing, your go-to market. So you need to have your marketing story. Going viral is not a strategy, we talked about that. You need to have your product development timeline, and you need to have your R&D, and those things depend on each other, and there's lead time. So before you get to market, this is an example from one of our clients that was making a 3D printer. Very complex product. So how many of you are in the hardware business? Anyone? Okay. What are you building? What hardware are you building? What is it? Okay. Okay. And what is your? Yes, you raised your head of hardware?
An accessory to it.
An accessory, okay. And you told us you had the campaign, right? Okay. So, but a 3D printer is a very complex product and requires multiple components and development on multiple fronts. Before you get a unit to the market, you kind of have to go backwards and say, okay, it's going to take me, my R&D is going to take to get to this point, then my product is going to take here, and then, so everything needs to be laid out. So when you start showing units in the market, it needs to be aligned with your story, okay? So that's why I'm saying the numbers come last. All of that needs to be at least thought after, okay? Okay, so let's talk about Sass, okay? I want to show an example of Sass metrics. So this is a very good industry to demonstrate this concept of unit economics, okay? So how many of you are familiar with this ratio? Customer acquisition cost, lifetime value, MRR, churn. Okay. The rest of you are not? Okay. Okay. Are you? How many of you are in the Sass business? Okay. Okay. How many of you have dashboards where you track those? A few of you. Okay. So we're going to talk about that. This is absolutely critical. If you're going to raise money as a SaaS company, There are very, very smart investors in Silicon Valley from whom I take these ratios, and I monitor this daily, okay? And these guys know the numbers inside and out. If you're raising money for a SaaS company from a SaaS investor and you don't know these metrics, you're going to be grilled over them, okay? So you have to go back to the drawing board and make sure that you might not optimize. I'm going to show you the ratios. You might not be optimized from the beginning, but you need to know, to show that you know the metrics and you're working towards that, okay? Yes? That's what this example is, so bear with me. Okay, so we're talking about the definition of customer acquisition cost is all your sales and marketing over a certain period, let's say a year, divided by how many new customers you added that year, okay? The customer lifetime value is 1 over lifetime, the lifetime of a customer, 1 over the customer churn. This is all monthly. The churn rate is what percentage is leaving every month, okay? I'm simplifying that, okay? And this number is usually something like 2%, 3%, if you optimize it, okay? Your lifetime value is your average MRR, which is monthly recurring revenue, which is what you charge per month, divided by, multiplied, so it's the MRR divided by the churn, okay? And I'm going to show you how I calculate that. So I just want to introduce that, okay? Now, why are these metrics so important in the SaaS business? So what's happening to the software industry, and we talked about, is that the industry has been switching from what's called a paid-up license model to a subscription model. So this is like a utility, right? People pay every month, and they can leave every month too, unlike a utility. So it's very easy to join, it's very easy to leave. So if you think about the economics, before, let's say you know this is enterprise software. This is I'm talking about particularly enterprise software. Let's say that you are an Oracle or any other company, and you sell software. Okay, you have salespeople going out. You pay them a salary. They sell something. They sell a license for 3 years, and then you have maintenance revenues every year. That's the model. So you cover the sales cost up front by the license, pretty much. Here you don't. So you pay the salesperson the same amount of money. They go out and sell something, but then you start collecting the money in little pieces. Like instead of paying $100,000 up front, they pay you, $1,000 every month over 3 years. So and they can leave at any minute. That's why the churn is really important. So so all of that is reflected in these, and that's why these ratios are so important. So what do investors want to see? They want to see these two equations. Okay. Now, these are not random. These are based on data and statistics related to SaaS companies that have successfully survived, because a lot of them don't survive. So this is an indicator for survival. If somebody is showing ratios that are entirely off of that, there's a problem. Me as an investor, I'm not going to touch this company, okay? So this is why this is so important.
Unless they are better.
Unless they are what?
Like off pattern.
Off pattern, okay. Unless you have a good story to tell. So what I'm always telling people is, you could be an outlier, but you need a good story to tell. Okay? If you don't have a good story to tell, don't be an outlier. Okay? So LTV needs to be at least 3 times the customer acquisition cost. We're going to show how we calculate that. So whatever your lifetime value, whatever that number comes to be, needs to be 3 times what it takes you to acquire a customer. And whatever this CAC is, there's a really important ratio, customer acquisition cost, you need to recover it in no more than 12 months. So if your customer acquisition cost is 100 and you charge $10 a month, is that okay? Yes, because you paid back in 10 months, okay? So that's kind of how it works. Okay. Now let's look at an example. I promise you it'll make sense. Let me just go through the numbers. Or is it
just this CIC? What cost do you put exactly in there?
Okay, you put your entire marketing and sales and marketing costs. Okay?
Nothing else.
Nothing else. This is marginal. This is just to get one more. Not your software development cost. This is all acquiring users. This is all marketing. Okay. I'll show an example. I promise you it all makes sense. Okay. So let's say that you have one sales. You pay $100,000 a year to a salesperson. and they have a quota. So they get you 100 customers a year. So what is your customer acquisition cost? You divide 100,000 by 100, you get 1,000. Everybody understands that so far? I'm going to use very simple numbers, okay? Okay. Let's say that your MRR, which is monthly recurring revenue, is $50. So every customer pays you $50 a month, okay? This is Sass. You charge monthly for cloud delivery. And let's say the churn is 2% every month, okay? So now let's run the ratios. So your LTV is 50 divided by 2%. That was the formula I gave you. That's 2,500. Okay, now let's look at these two ratios that we talked about, okay? We talked about LTV needs to be 3 times CAC. It's 2.5, so it's too low. So that means that your lifetime value that you calculated divided by customer acquisition cost is too low. And your monthly recover are too high. So you take the 1,000 divided by 50, you get 20, okay? So how do you get this back in balance? It's my question.
Increase the price.
What can you do? Increase what?
Price.
Increase quota. So by increase quota, you mean which of the ratios are, what are you trying to manage? Which of these ratios? Lower CAC. So number one, lower CAC, okay? So how do you lower CAC? You can increase the quota within reason, right? There's also, you have to remember, you can change markets, okay?
You might be targeting small and medium businesses. It might be better to do that.
What would that give you if you change markets? The ability to
raise your MRR.
Okay, so that's increasing MRR, so that's number two. So number one is reducing CAC. So you can increase the salary, you can decrease the salary, you can increase the quota, right? You can also, within reason, or within what the market would bear, increase the MRR. This is usually a very competitive market. So that kind of range, and if you move to a new industry, you might need to pay this guy more. So what we're seeing in Sass is the salary of the salespeople is kind of correlated with what they're selling, okay? So, because there's a whole funnel behind this, and we're not showing the whole process, I'm just showing you kind of the end process. What else can you do? What can you do? What can you do about this one? Reduce the churn. Okay, reducing the churn, bring the churn to a minimum. So the more people leave, the higher churn, this thing gets lower, and then you're out of balance, okay? So, so these are all great. I think we touched on all the points. So lowering CAC, increasing MRR, lowering, managing churn to a minimum, increasing your MRR. So what you see a lot of SaaS companies doing is upselling. So once you have the customers, you try to sell them more and more and more things. You want to always increase your MRR because you are bleeding cash. I don't think I have the chart here, but in your first years, when you're in hyper growth, SaaS companies lose money and they're bleeding cash because of the fact that you pay this guy $100,000 before you see this money coming in over a long time, and some of them drop, right? So we need to make sure that, and that's why these ratios are so important, because these are indicators of survival. Yes, now you can ask me other questions. Okay, go ahead.
Do you have calculations on offering a discount on a yearly, like it's a monthly fee, but if you pay yearly, you get 10-20%?
Yeah. So what a lot of SaaS companies do is that you want to lock the customer. So part of managing the churn down is making sure people don't leave. And one way of doing that is selling a monthly subscription in an annual package. Okay, so and what I'm hearing is that this annual package now you're seeing even 3 years of annual packages, of course for a discount. But the cost for you of this guy leaving outweighs the discount that you give them. You see?
So discount is like, is there a formula where you say like, if you don't...
There's a lot of SaaS formulas. Yeah. So yeah, part of what I'm going to show is that if you want to learn more about SaaS, we have more advanced things that I'm teaching, but this is just introduction. There's a lot of SaaS. We can sit all day and play with these ratios. Yes?
When you're calculating your customer acquisition cost,
yes,
you incorporate in the customer retention cost as well. So if you build a team of field apps engineers, does that go into the CAC?
Are you talking about things like customer success team? Yeah. Okay. So that to me is part of overhead, not part of customer acquisition costs. Yeah. So it's kind of a gray area. It's It's not a bad question. Yeah, we're going to talk about overhead. Yeah, but what overhead is something to me from an accounting perspective. We're going to talk about cost in a minute. It's more not so marginal. So when you think about should I include it or not, you should think about for every one additional customer, do I have to add cost in that area? And if the answer is yes, then that comes into your customer acquisition cost. But you know, in real life, we don't just have this. There's a lot of also, you know, in terms of marketing, some of that goes directly to that. Some of that is branding costs, right? You're building a brand. You know, how much of that do you include in that? There's all these questions. Okay. So that's unit economics. So when you're doing a SaaS model, it's really important to understand all of that because that determines a lot of your cost, a lot of your headcount, your org chart. How many people do you hire? You know, you're trying to make all things balanced for you. So but eventually it impacts your growth. So if you want to plan on a growth pattern, like growing so many customers a year, you have to make sure that you have the right balance of people that you're paying and how many customers they can sell you and how much are you charging for it. So I hope now it makes more sense when you see the ratios and how they interplay. Okay, I'm just gonna, we have about 15 more minutes. I'm just gonna go over some of the revenue and cost, other things that are not the marginal things that we talked about. These to me are the most important thing. This is like the heart of the model. You gotta get that right. The rest of the stuff that I'm gonna talk about now is what are the things that you're adding on top of that, okay? So in terms of revenues, so we talked about SaaS. So SaaS, there's one revenue source, there's more, okay? Eventually, maybe you can sell advertising, you can do other things. So I always say keep it simple, right? Somebody asked me, you asked me. Keep it simple means that you might think about 10 different revenue sources, and that looks great to you.
No, I thought about more like mixing the models by using licensing and B2B2C.
Or mixing the models, or what have you. I would just say keep it simple. So if for example, in my example, you could think about 8 revenue streams. Let's stick to the 2 or 3 that make 80% of your revenues because that's always usually the case. You don't need to quantify every like 5% of your revenue. Just use kind of common sense and we say in accounting, materiality. Okay, so stuff that's material. That's what you want to show investors. It also shows that you're focused. You know, there's a lot of benefits to that. Project revenues at least 3 years out. We talked about that, so investors can see their exit point and do their own calculations about their return. And benchmarking is really important, but in my mind, you do benchmarking at the end. So let's say you build out your units and projections. At some point, you kind of want to make sure that you are sitting within your market in a way that makes sense. So you're not claiming 50% of the market, right? So whatever you are showing is, maybe it ends up being 1%, but you don't start from the 1%. See what I'm saying? You're going to build it from the ground up. You know, you're going to sell SaaS subscription. Let's build it from the ground up, understand the ratios, and only then see how many users we're predicting and comparing it to the market. But don't start the other way around, okay? That's about benchmarking. These are some of the common sources of revenues that we're seeing in software companies, but not just in software companies. Kind of aggregated all of them here. I mean, there's variations of that, there's combinations of that, but these are the things that we see the most, so this is just a list. How do we know for our own industry? You kind of look at what's common in your industry. So you look at public companies, that's one good place to. The good thing about public companies is that the information is public. So you can see what successful companies are doing, that's kind of telling you, you might not be able to do everything that they're doing, but it's a good indication as to relationships between things, and some revenue sources rely on others, so you want to make sure you have the good proportion between things. Check with public companies. What is the criteria for revenue model selection? Okay, you need to look at the type of user, whatever industry norms, and whatever the product that you're selling. So you can't do everything with, you know, some things you can't charge for at all. Like a lot of the B2C stuff, like mobile apps to consumers, you can't really charge for. Okay? People are not going to pay. You can monetize them in different ways, but charging upfront for the app is a hard thing for a consumer. not so for an enterprise. Okay, so you kind of have to look at what is the product, what's common in the market, and you know, there's room for creativity. I'm not saying that innovation in business models is not a good thing. It's actually a great thing. It's something that requires additional explanation, especially to investors. So if you have a creative business model, revenue, or other aspects of your model, it's not. I'm all for that. Actually, a lot of the work that I do in intellectual property is finding innovative business models. That's a lot of what we do. But always just have the good story. Be prepared to explain that. So because you're getting out of the norm of what people are used to seeing. That's all. But it could be a good idea in certain situations. Okay. A few words about cost. So when it comes to cost, I always like to model cost by functions. And these are kind of the main. I'm actually going to go over that here. Modeling by cost functions. So cost of goods sold are the direct costs related to every unit that you sell. Okay, it's easy to explain within manufacturing. That's the cost of your raw materials. In sales, it would be sales commissions. So everything that you have a cost, every time that you get revenue, you get a cost. That's direct cost. Everything below that is mostly in the category of fixed cost. We have R&D, which is a big cost item, sales and marketing, and everything else. So why am I encouraging you to model cost in functions? Because eventually you want to converge the industry ratios. You don't start with that, but if you keep your cost in these categories, you know what you need to aspire for in year 5, year 6, and beyond, okay? If you don't start like that, so the largest cost item for companies is payroll, okay? So if you keep all your payroll in one bucket, and we're going to talk about payroll in a minute, but an org chart looks like that. So that's your basis for predicting payroll is you build the org chart. This one, we color code it like by years of hire and functions. But keeping it in functions helps you then roll it up, into this, okay? So a lot of the components of that is payroll, okay? But what I'm advocating is you start with, always do an org chart and try to think about it at least 2 years out. That thing is kind of hard to think beyond that. So what you do beyond that, then you kind of see how the proportions work and you kind of predict it out, converging into your industry ratios in the later years, okay? Okay, so when we talk about payroll, build an org chart, use salary surveys, use fully loaded salaries with benefits, with raises, with bonuses, with everything that needs to go in there, insurance. Employees versus contractors is important to keep in mind. Do you guys know kind of the trade-off between these two? Okay, so it's very tempting to have people work for you on an hourly basis and pay them per hour, and they're not employees and you don't pay them benefits, and there's no employee taxes and all that. The state of California is very strict about that. So if somebody looks like an employee, they might come after you and ask you to make them an employee. And there's all sort of whistleblower rules that have been enacted recently to encourage people to report that. So what I'm saying is that always keep that in mind. When you build an org chart, this is based on salaries and payroll. Okay, so, you know, we always have contractors. Not everybody needs to be an employee. If you have somebody overseas developing, that's a development. That's fine. But somebody working for you, coming every day to work under your direction, and there's all sorts of tests for that, that's an employee. Okay, so it's important to understand that. Cash versus equity compensation is also important to understand when you talk about payroll. State of California requires to pay people in cash. Okay, I was a CFO of a startup, and I left before that happened. But the employees took the CEO to labor commissioner not far from here in downtown San Jose because they stopped paying salaries and you know, a lot of other things like that. So you know, if you're obligated to pay, you're obligated to pay in cash. So these things are important to keep in mind when you take employees in California. But other states, other countries, that's not my area. I'm not a labor lawyer. Okay, when you build the model, that's why you think about these things, okay? Yeah, so we talked about that. We talked about modeling by cost functions. So this is kind of what I had out here. Modeling by cost functions. Year 1 and 2 are predicted on a monthly burn rate basis. After that, you can start using percentages. It's usually a very complex spreadsheet, so that's kind of what I can say from a high level. Hopefully that it gets you thinking about some of these things. We talked about variable versus fixed cost. We talked about an org chart. Okay, so bring it all together. Okay, so I'm getting to my concluding slides. Okay, good time, kind of. A few minutes over time. Let me just finish and then I can answer questions after that. So what I want to show is I want to show you a funding simulation. So this is how, when we bring everything together, going back to what we started talking about, which is the funding and the valuation. And so the purpose of getting all the numbers together is eventually to have something that looks like that, okay? And what is that? That is an example of a SaaS company. Now, I apologize. I thought the numbers would come out bigger, but I'm happy to send you these slides. So, so what we're doing is, let's say this is a SaaS company. So these are some of the metrics that we talked about here. The sales quota, the salesperson's annual salary, the churn rate, just that, okay? And that kind of translates into your headcount and your, fixed cost and direct cost and revenues, okay? So, but what's really interesting here is that there's two scenarios here. One is, so the whole purpose of doing that is not just looking at nice numbers, is really to use this as a planning tool, okay? So the decision that you always have is, there's a few things, but what you show investors, you want to show the pace of growth. So how quickly are you going to grow, okay? And this is also here, you can play with your starting valuation, which we don't have time to talk about a lot here. And so let's say, what is the difference between 10% growth and 5% growth, okay? So if you do all of that and you implement a lot of the things that we talked about, and we do it on a spreadsheet so we can change things as we go, and right here, this is actually going to determine how much funding you need every year. Because what this is showing you is it's showing you what you can hope to generate and what you can hope to, what is the cost for you. And these are just made up numbers. So we don't go raise money every year. We usually raise money at least for 2 years, but this is just to show, you know. So this is kind of showing you the funding every year. This is showing you cumulative funding. This is showing you, there's a line here that you probably can't see, but this is your valuation. This is a multiple. So it applies to the revenues that you're showing, and it kind of shows you your dilution trajectory, okay? You know, if you grow here at this pace, you get to this, and this is how much you have to raise. And if you grow at a lower pace, you're diluted less, and you need to raise less money, and eventually your share of the company, which is not calculated here, you know, is going to be higher or lower. So this is kind of the trade-off that you have. You can get diluted more, right? Here, you end up with 42% of the company, but you raise less money and you grow less, okay? Here, you raise more money, you get more diluted, but at the end of the day, where are you better off, and where's kind of your, you know, there's a lot of things that we can see from here. But this is how we kind of bring everything together, okay? And we create it in a very flexible way, so you can also, there's a Sass metrics running in the back to make sure that you don't increase prices, you know, increase salaries, do something to mess up the ratios. But at the same time, you understand, A, how much money you need to raise. Remember where we started from? How much money you need to raise. What impact does high growth or low growth have on your own dilution and your own share of kind of take away from the company, if you can estimate that roughly. And yeah, so that's why we're doing that. Okay, so that was my concluding slide. I'm happy to share that with you. You know, in my slides, so you can look at that if you have any questions. Yeah, so that's the end of my talk today. I just wanted to mention again that so a lot of the services that we do help companies kind of figure these things out. We work with you on your business model, financial model, valuation, funding strategy, which is this. This is funding strategy, okay? And your IP strategy, which I didn't show here, but I talked a lot about. And you're welcome to ask me, an IP lawyer, and we can work together, as I said. So if you have any questions about our IP services, by all means, you can ask either myself or me after this. And yeah, and we have two things that we're doing for people who came today. One is the introductory consulting session with every startup, and I'm happy to talk to you after the presentation about that. And the other thing is that we do, and we had some demand from some of the other talks that I gave last week, is do more Sass modeling. So if you're interested in that, let me know. We'll be probably doing classes through the summer where we can dive deeper into some of these, help you build your own model. And yeah, just let us know. There's I have cards here. There's there's a little bit of information about our company here. And
How much do you charge for the
you come and ask me and I'll tell you. Okay. Okay, this is it. Thank you very much. If you have any more questions, I'm going to stop.